Next up is a question from the captain. My elderly parents have a small whole life policy they've held for 35 years. How can I help them evaluate whether it makes sense for them to maintain the policy, cash it out, or something else?
Yeah, this is a really difficult question because insurance products are not all the same. They're not all created equal. And even insurance policies that are put in force today are not the same as ones that were put in force 30 years ago. So unfortunately, we won't be able to directly answer your question for like, okay, how do you do this? But the analysis that you need to go through are some pro and con analysis, because there's a really good chance if your parents have been paying into this whole life policy for 30 years, there's a chance that it's maybe what's called paid up, meaning no additional premiums are required, no additional money has to go into it. It might be self-sustaining, that they could just stop putting money into it and the cash value therein that exists will be enough to pay for the death benefit for the remainder of their life. So basically it's a self-funded, paid for life insurance policy. The other alternative is you could look at surrendering it, and you got to see what the cash value is and what sort of costs would be associated with that. And you basically have to do a T-chart, right? Pros of keeping the policy, cons of keeping the policy. And then, unfortunately, I think you got to call the insurance company and ask them what options are available. Because sometimes you have to do this. You have to say, okay, hey, this policy is not yet paid up for the death benefit that exists. How much paid up insurance would there be if I wanted to convert this to a paid up policy? And like, if I had a $100,000 death benefit, maybe there's a $70,000 paid up option, we'd have to put any more money into it. So you really have to do sort of this cost benefit analysis around what options are available to you. And then once you see those 3 or 4 options, which one of those options is the most advantageous for your parents?
First step, you got to figure out the why. And let me tell you the why for what you're doing with this when you look at this policy is because if you don't know the purpose for this, and do you need it or do you not need it anymore, is you might be susceptible to sales or all kind of other things. Because remember, life insurance, a lot of times, the fees are front-end loaded. So I always say before you do anything with a whole life, figure out what the why is on it or any existing policies. And then you can also, how old is this policy? Because if you've already made it through the gauntlet of paying all the high fees, now it's saying, well, are there some actually good redeeming things that are going on with this older policy? So that's what I would want to know. What are the annual costs of this policy? What are the annual premiums that they're trying to charge you? And then you're going to have to go, here's your homework list. You got to go figure out the paid up coverage, meaning that you call the insurance company and you say, hey, how much, if I just quit paying premiums today, will the cash value allow this to make it until whatever age I live to's death? What's the benefit that it would pay me? And then you need to know the surrender cash value. If you pulled that money out tomorrow, what's that surrender cash value? And then you need to ask a question of what's the basis, because what you actually get to keep is that that surrender cash value. That's probably might be potentially taxable if your premiums, if the value exceeds what you paid in premiums. That's what basis is how much you paid in on premiums. But compare those things. Know the why, though, because I ran into this. I just did this 2 weeks ago for a client, and I gave them all this list of variables. I need to go call the insurance agent. I need to know all this because we might just let this thing just ride out, figure out the paid up, and just let it go because there's still some need for some insurance. But here's what actually happened. Called the insurance company, and they immediately, well, let us just roll that. We'll do a like kind exchange of that cash value into a brand new policy. And we can, instead of this, because these were policies that were written back in the late 70s. And so the policies were only like $25,000, $30,000. I mean, the face value on them was not relatively that much. Death benefit was very small. They're like, well, how about we get you a $100,000 policy now? And I was like, no, this is. They have changed the equation and are asking questions. We are trying to give you answers for things we didn't even have on the docket for what we're trying to do. So that's why you better do the homework of knowing your why before you call them, because they don't want to let go of the money. They're going to want to, and also realize there's a big incentive to rolling this cash value into a brand new insurance, because then you get to collect fees and you get to start the clock all over again. And remember, your benefit is you've already paid all those fees. You're now on the other side of the fees. So let's figure out if there's some redeemable value here through paid up, and the benefits. So, and that doesn't mean that, because if you're young, and there might be options to buy more insurance, but we still like term for the majority of people. So whole life is valuable for a very specific purpose. So you better do the homework on the why before you do anything else.
But once you're in it, you have to do the analysis to make sure, because don't just assume that because you have a whole life policy, immediately you should surrender and get out of it. Because, again, if you've been in it for a long time, it could have valuable benefits, like a really solid dividend that's paying, perhaps, especially if you have elderly parents, better than their rate of return on other assets. So you want to, again, it's a whole analysis you got to do. It's not going to be a blanket.
And I don't want to know what other riders are attached to it, because like do they put a long-term care provision on there? There might be something, especially if you have health issues now, but you didn't have health issues back when you got the policy. Pay it. All that stuff matters, and I hate I hate answering questions with questions, but these are the multiple facets that go into making good financial sound decisions, and that's why I don't think planners, our job's not going away.